Welcome back to Investing Talk podcast.
Today we're looking at Confluent.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yeah.
And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're really going to be dissecting Confluent's story, focusing on their financial pivot, their competitive position, and I think most importantly, how their tech is becoming this must-have infrastructure for the AI revolution.
Okay, let's unpack that financial story first, because it really feels like a narrative in transition.
It really is.
The Q3 2025 print was strong. We saw about, 19% year-over-year revenue growth?
Right, but it's the longer-term trend that's so impressive. I mean, you look back to 2022, 2023, and they were in that $150 to $170 million range. Now they're pushing almost $298.5 million in the latest quarter.
So that implies a compound annual growth rate in the low 30s. That's some serious acceleration.
It is. And for investors, it's not just about the speed, it's the quality of that growth. Confluent has what you'd call a best-in-class SaaS profile. Gross profit expanded from around $100 million to over $700 million.
A sevenfold jump. But is that kind of quality sustainable?
It seems to be, because the gross margin is so stable and so high, it just holds firm right in that mid-70% range.
Okay. And that's the key metric.
That's the critical metric. It gives the company confidence in its future operating leverage. When your gross margin is that high, every new dollar of revenue just flows so much more efficiently to the bottom line.
Speaking of the bottom line, this is where it gets really interesting, right? The profitability inflection.
Yes.
For so long, this was a classic hyper-growth, high-loss tech company. But now, they're consistently beating street EPS expectations.
And not just beating them, I mean, in some cases, demolishing them. You look at Q1 2025, they did 8 cents versus a 7-cent estimate. Fine.
A small beat.
But then Q3 2025, they posted 13 cents in earnings per share when the expectation was -1 cent.
Wow.
Yeah.
That's a massive swing.
It's a huge swing. And it signals that the market is still deeply underappreciating their ability to execute and their path to positive earnings.
So management's clearly feeling confident. They raised their full-year guidance after that Q3 report.
They did.
Yeah.
And they're explicitly tying this success to the biggest trend in tech right now, AI.
Right.
Management is framing this AI-driven demand for data streaming as their primary long-term growth driver. And this isn't just, corporate buzzwords. It's based on a real need.
Okay, so before we get into the whole competitive moat, which we definitely need to spend time on, let's just quickly check the financial stability. How's the balance sheet looking?
It's on solid footing.
Yeah.
Their current ratio is strong, around 4. So they have $4 in current assets for every $1 in short-term liabilities.
They can cover their bills.
Easily. And debt to equity is about 0.99. Pretty typical for a growth SaaS company that's investing heavily, but it's very manageable.
But the most critical financial point, for me at least, has to be the cash flow story.
Oh, absolutely. This is the inflection point. Operating cash flow has improved dramatically. Not long ago, they were deeply negative, something like -$157 million.
That's a lot of burn.
A ton. And now, in recent periods, it's swung positive to +$33 million. That's a major milestone. It points directly towards sustainable free cash flow generation.
And that FCF is the engine for the future. That means they can reinvest in R&D in their cloud services without constantly having to go back to the market for more cash.
Exactly. That's how you build a long-duration growth story.
Now that we have the numbers, let's talk defense. Because in tech, growth is worthless if you can't protect it.
Yeah.
What is the moat here?
The moat is extremely deep, and it starts with their origin story. Confluent was founded by the original creators of Apache Kafka.
Okay, and Kafka is the industry standard.
It's the de facto global standard for data streaming. So Confluent took that open source tech and built a fully managed cloud-native enterprise platform around it. They basically own the ecosystem.
So you're not just buying software, you're buying the best, most secure way to run the industry standard.
You've got it. And that creates incredibly high switching costs.
Yeah.
I mean, think about a giant bank or a retailer. Once they've built their mission-critical fraud detection or inventory pipelines on Confluent,
you're not ripping that out.
Ripping that out is, well, it's extraordinarily costly, risky, and time-consuming. It's just incredibly sticky technology.
But they can't have a free pass. How do they defend that niche against, the two biggest threats? Free open source Kafka and the cloud hyperscalers like Amazon and Microsoft.
That's the key challenge.
Yeah.
Against open source, Confluent offers enterprise-grade features the raw version just doesn't have. We're talking guaranteed uptime, advanced security, governance
There's
tools.
stuff a big company actually needs to run in production.
Exactly. And against the hyperscalers, that's a tougher fight, but their differentiation is specialization and multi-cloud.
So they're not locked into one vendor.
Right. Large enterprises want to avoid that vendor lock-in. Plus, Confluent's entire focus is on data streaming. They provide a better developer experience, more advanced tools. It's a level of expertise that generalist cloud providers just haven't matched yet.
Okay, let's pivot to the really big catalyst here, the AI connection. Is this real or is it just good marketing?
Oh, it's absolutely foundational. Modern AI is all moving away from batch processing on stale data to real-time inference and training. Confluent is literally the delivery mechanism for that real-time data.
So how does that work in practice?
Well, think about a modern AI architecture like retrieval augmented generation or array.
Which so many new applications are built on.
Exactly. RAG needs to access external knowledge, like a vector database, in real time to give the language model up to the second context. Confluent's platform is what feeds the data into those vector indexes instantaneously.
So it's the plumbing. It moves the data from where it's created to where the AI can actually use it.
It's the essential plumbing for the AI era. If you want your AI product to be smart and fast, not dumb and slow, you need something like Confluent. It's a massive long-term secular tailwind.
Okay, let's talk market dynamics. Looking at the chart, what's the technical picture telling us right now?
Technically, the stock is seen as somewhat bullish. It had a really strong rebound after the last earnings report, which shows conviction, and now it seems to be consolidating those gains. It looks like an accumulation phase above key moving averages.
And there's an interesting valuation argument, too. The stock was trading around $23 against a fair value estimate of nearly $28. That suggests about 17% upside baked into the current thesis.
Right. It implies the market is still catching up. And that's before you even factor in the M&A speculation.
That was a huge story. The stock surged, what, 32% on those unconfirmed acquisition talks?
It did. And the reported valuation was around $11 billion. That tells you that the big strategic players see Confluent as a scarce, vital asset for competing in the AI infrastructure space.
It puts a sort of floor under the valuation.
It introduces a potential takeover premium, absolutely. It's a strategic piece on the chessboard that's very hard to replicate.
Okay, we've covered a lot of the bullish case. Let's be balanced. Let's move into the bear case and really dig into the risks. What's headwind number one?
Risk number one is still GAAP profitability. We touched on it, but we have to stress it. They are still significantly unprofitable on a GAAP basis. We're talking net margins around negative 27 to 30%.
And until that flips, they're vulnerable to market sentiment shifts, right? When growth is out and profitability is in.
Precisely. We also see this in their Altman Z-score, which is 2.51. That's considered the gray area. It's not a distress signal, but it's not a sign of bulletproof safety either. It just reinforces that they need to keep executing on that path to GAAP profitability.
But the counter to that is the strong gross margin, right? That 74% number, and the positive operating cash flow. It shows a clear, credible path to getting there as they scale.
It does. It's a strong mitigation. But then you have risk number two, which is more about sentiment. There's been news of a securities fraud investigation being announced.
Which is often just headline risk for these kinds of stocks.
Often, yes. But you also have notable insider selling. The CEO sold over 200,000 shares. The CFO sold some as well.
And insider selling always makes investors nervous. The official line is that these sales were to cover tax obligations. Is that a credible explanation?
In this context, it seems to be. These are often part of prearranged trading plans tied to stock options vesting. If the execs were truly worried about the business, you'd likely see a much broader, more sustained pattern of selling. Given their large remaining holdings, the market seems to be buying the tax management story.
And you have the institutional money flowing the other way.
Exactly. You see big holders like Blair William and company actually increasing their positions. That tells you that the smart money is looking past the short-term noise and focusing on the long-term thesis.
Okay, let's tie all these threads together then. Confluent is emerging as this mission-critical data backbone for AI. You have high growth, incredible gross margins, and a rapidly improving earnings picture.
Right, and you combine that execution with their strategic role in AI and the M&A speculation, and it really feels like the market hasn't fully priced in the long-term opportunity yet. It's an attractive risk-reward for anyone wanting exposure to the growth of real-time data.
So what does this all mean for you, the listener, in terms of strategy? This doesn't seem like a quick trade.
No, absolutely not. This is best viewed as a multi-year hold. Think 3 to 5 years, betting on those huge secular tailwinds of AI and real-time analytics. Any short-term volatility from headlines or market jitters could be seen as an opportunity. The strategy here is to focus on that long-term vision of them becoming the data standard for the next generation of applications.
If you found this analysis helpful, make sure to subscribe so you don't miss our next breakdown.